What's up everybody, GenExDividendInvestor here. In this video I'm going to share some information that will give you insights into market crashes and recessions to help influence your moves in the market. First, what is a stock market crash? Well, it normally is when a stock market index like the Dow falls over 10% in a short period of time, like days. Crashes can be different than bear markets, which are markets that decline for months or even years. That means we can have a crash which doesn't cause a bear market, or we can have crashes which are the beginning of bear markets. Crashes are generally unexpected. That being said, there are people that I call doomers that are almost always predicting the end of days for the stock market, the economy, the dollar, etc. And like my grandfather was fond of saying, even a broken clock is right twice a day. For me, it's not that interesting to listen to someone who just says the same thing over and over, even when they're wrong for over a decade. And those people tend to be the same ones that will be beating their chests about their prestigious prognostication powers when the market finally does turn south for a while. Try to say that 3 times quickly. So I tend to discount people who are always preaching that the American dollar is a weak currency or that it's a fiat currency, as that person's bias overly clouds any objectivity that would cause me to listen to them, as what they preach doesn't follow the actual data. The reality is, no one on earth can consistently and reliably predict the future, whether it's when the market will crash or how long a bull market will last, and anyone who tries to tell you that they can predict the future is obviously lying. Remember, anyone can sometimes guess things correctly, but no one has ever been able to consistently predict the future correctly. So beyond crashes, we also have recessions. I pulled this chart from a Morningstar article. In this article, they created a new metric called a pain index, which measures both how much the market fell and how long it took back to get the previous peak. We see that the Great Depression in the early 1900s had the most pain. Then we see that the combination of the dot-com crash and the financial crisis was the next most painful period. Then we have Vietnam and Watergate, and after that World War I combined with the influenza outbreak, and then the 5th most painful stock market period was World War II. So how often do we go into recession? Well, from 1797 until now, there have been 17 big recessions in US history, which includes the Great Depression. So while recessions don't follow a timetable, if we wanted to calculate a simple quick average, we could say that a notable recession occurs every 13 years or so. Our last notable one was in 2008, which lasted about a year and a half. That one was caused by the subprime mortgage crisis that created a global bank credit crisis. Before that was the dot-com recession, which was in 2001, which lasted 8 months and was caused by the boom and then bust by dot-com businesses, where tech companies had ridiculous evaluations without any profit to back them up. So here we are in 2020, and we haven't had a recession for over a decade, so if we had one now caused by the pandemic, it shouldn't be too surprising. That being said, we actually just had a stock market crash in March of 2020, aka the COVID crash. This occurred just as COVID was spreading, and then the Russia-Saudi Arabia oil price war was happening, and then we had travel bans, and all that led to markets crashing. But we've already recovered and are now at new highs, which is crazy. Recently I was chatting with someone, and they asked me if what is happening with Apple's run right now reminded me of the dot-com bubble. So I'd say it isn't just like the dot-com bubble, but it may very well be a bubble. Apple is at a 37 PE, so that seems up there, but then compare that to Tesla, which I'm also long in, and they're at something like 1,000, which seems crazy to me. So let's talk about why this time has some unique characteristics. I found a great article on Slashdot that helps share some differences between now and the dot-com days. First of all, these days we only have about half as many US public companies. So that means a lot of fat was cut after the dot-com bubble burst, aka stronger companies have survived and weaker ones have disappeared. During the dot-com days, the median age of a company that went public was only 5 years old. Think about that. You go from starting up to going public in only 5 years. And now for the last decade, it has doubled to 10 years, which often means that businesses that go public have proven a longer duration of time that they are both surviving and growing. I remember the dot-com days. New startups existed really just to cash in and go public. I worked at a place in the late 90s and early 2000s where everyone would have become millionaires if our company had gone public. But they didn't, and all of our private stock ended up being worth zero when they went under. Now that same article I was talking about said that the Russell 3000 Growth Index, which is a market cap weighted stock market index that seeks to reflect the entire US stock market, currently has a net debt to earnings ratio of just above 1. Compare that to 1999 when it was about 2.3, which means that back then companies had more debt with less earnings. But not only that, debt back then also came at higher interest rate levels. Take a look at the federal funds rate right before the dot-com bubble burst, and we see it was almost at 6.5%. Compare that today where we are at 0.09%. So now we have less public companies that have been around longer, have more profits, with less debt, and the internet business model has proven to work, with companies like Amazon and Google and Facebook all raking in incredible amounts of revenue. So is the market going to crash, and if so, when? Like I was saying, you need to completely ignore anyone who says they can guarantee something will happen in the future. That being said, I guarantee the stock market will crash. See what I did there? Seriously though, it's inevitable we'll suffer a crash and then we'll have another bull cycle. That's a normal and healthy cycle for things to get too hot and then correct. That's been the case for the last 135 years of the US stock market. The thing is, no one knows when. So while I think we have a few companies that seem to be more open to a correction than the overall market, it's also true that things are different now than it was in 2000. While some market conditions are better, we also have a new big X factor in the mix with the pandemic, with various actions governments have taken because of that, so anything's possible. I personally thought we would have seen a much bigger correction by now, and I tend to be an optimist. We still had 2 of the 5 largest percentage drops in the 135-year history of the Dow in the March drops, where we dropped 10% in one trading day and about 13% in another. But we also had the 4th largest Dow gain ever in March, where we gained 11.37% in a day. If we look historically, we see that there were around 30 times where stocks lost 20% or more from their peaks, lasting from 2 months to over a year. But we had more bull markets than bear markets during those times, and not only that, but bull markets tend to last longer than bear markets, and tend to yield gains that more than compensate for the downturns. So while stock values might have lost around 36% during bear markets on average over the last approximately 100 years, they gained over 110% on average during bull markets. So bear and bull markets are normal, so you just need to be prepared mentally and financially. Now, another stock market evaluation metric that some people like to look at is Warren Buffett's market cap to GDP indicator, which he once called the best single measure of where valuations stand at any given moment. Recently, the historical average of the indicator is 1, or 100%, and before the dot-com bubble it hovered at 1.6 to 1.7. Currently we're at about 1.3, so still a ways to go to get the dot-com levels, which tells us that the stock market is highly overvalued. But GDP has obviously taken a hit due to the pandemic. So the obvious signs tell us that if the pandemic persists unabated and the trends get worse, then thinking the market will suffer is logical. However, if we do get good news on resolving this sooner rather than later, then we might escape unscathed. Either way, I stay long on quality American companies I love, like Johnson & Johnson, Microsoft, Apple, Procter & Gamble, and McDonald's and such, and I'll ride the volatility that may come. I feel good about those companies' futures, amongst others I hold, and I'm excited to remain an owner in their stock. The more people freak out, the better you should feel from an investing standpoint, as it's when everyone is bullish that things often turn south. There is obviously still a disparity between the stock market and the general US economy, so another wave of pandemic-related things could come and do God knows what. We're also in an election year, and the market could react unfavorably to that. From where I sit, I think the pandemic will be the main factor that will either be the catalyst for the recession or not. If the pandemic continues, then larger layoffs might be coming, which in turn will squeeze consumers' ability to spend, and then the dominoes could keep falling, which could mean a larger and significantly longer stock market impact. Of course, the Fed continues to extend its US dollar repos and swaps and keeps interest rates down, all of which is probably helping keep the markets driving up. Of course, that Fed action has long-term implications, but it seems that we have been in a pattern of just kicking the can down the road for a long time, and that's not a good thing. So what else could we look at to try to figure out if the market's going to crash? One school of thought is to follow the smart money. So what is smart money? Well, the big fund managers, aka the institutional investors who manage billions of dollars. How can you do that? Well, the SEC requires mutual fund managers to disclose their portfolio holdings each quarter. Then you can compare what funds they hold from quarter to quarter to reveal what stocks are getting the most love. You can also go to the websites of the largest funds, where you can see the biggest holdings and percentages of each. There are also pay sites which tell you things like how many funds own a particular stock in the last quarter, which allows you to trend things. You can also look at trading volume to give you more insight into those quarterly disclosures that big financial institutions do. The problem with that approach is that there's a study done in 2013 which found that fund managers who buy stocks based on what other big managers are doing have the lowest returns. And that kind of makes sense. If you're always a quarter behind, then you're just chasing others. Another way people try to determine if things are getting too hot, which can mean a correction is coming, is to look at the overall market average PE trends. This PE trend graph is from longtermtrends.net. Recall that the PE ratio is the index's current market price divided by the earnings of companies in the last 12 months. So what do we see? Well, we see that PE has been trending up over the last 100 plus years. We also see that in 2000 things got way out of whack, and then in 2008 it was even crazier because earnings fell so low. Now there is a newer metric trend people follow, which is called the Shiller PE ratio, which divides the price by the average inflation-adjusted earnings of the previous 10 years and is also called CAPE ratio, or the PE10. This metric implies that we've been in an extreme bubble since 2013. So what should you do? Like always, you need to make sure you are prepared whether we continue making new records in the stock market or if we go into a 10-plus year recession. So make sure your finances are in order, get rid of bad debt, make sure you have an ample emergency fund, have some dry powder ready to deploy. Consider starting up a digital side hustle aligned to a passion you have, to both hedge your future and your career, as well as do something positive and creative that you can own. Finally, I'd like to leave you with this quote. Great things never come from comfort zones. You know who gets six-pack abs? The people who are willing to put in the effort to work out hard and control their eating. They prioritize their gym time and don't let excuses stop their progress. You know who does well in business? People who commit and focus and go above and beyond what others are willing to do. It's human nature to avoid pain and suffering, but all the best things in life come from overcoming a struggle. Embrace the pain and drive through it. Please subscribe if you haven't, and consider clicking that bell notification, and consider checking out my Patreon page. Thanks for watching, and remember, don't forget to join my dividend Discord so you and I can finally chat. Goodbye, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.